Hi, I'm Jenny Brown and welcome to this week's MFB News. I hope everybody is really well and that you've had a good week. I am in the office for a change on a Wednesday, so what you may see is some dogs running around. We've got a couple of dogs here today, so if you do see some little four-legged friends go running past, your eyes aren't deceiving you. They are genuinely dogs. Now, in terms of what we've got to cover off with you today, we have some new limited edition rates that have come out, which are actually really competitive, so I'm looking forward to sharing those with you. And then we're just going to have a quick update on house prices, and this is going to be our penultimate video for this year. So next week what we're going to be doing is just really giving you a rundown of 2021 and the kind of overarching news that we've experienced over the last 12 months. Okay, so first up in the last week, Landbay have released some new limited edition pricing on their large HMO multi-unit product range. Now, for Landbay, a large HMO would have 12 rooms and a large multi-unit would have up to 12 self-contained units. And the pricing here now starts from 3.79%, arrangement fees are 2% of the loan amount. Now, if you've got a smaller HMO or multi-unit, first of all, Landbay will offer you a different product set, which is more competitive. But likewise, there's a lot more appetite in the market for this smaller HMOs and multi-units. So generally speaking, 6 bedrooms or 6 self-contained units. Anything over that kind of size, and the options from lenders starts to really restrict. Therefore, you find the pricing, often will increase. So in terms of pitching themselves in the market, the 3.79% rate is actually not bad at all. I will come back to the pricing with Paragon though at 2.99% on a 5-year fix with a flat arrangement fee of 1,995. For me, that product is really stand out. But look, the Landbay option is still very good. So in terms of Landbay, what they've also done in the last week is they have made some adjustments to their pricing as well. So they've dropped some of their rates down by 5 basis points and introduced a cashback on certain products. So I think really what's happening here is that Landbay are kind of really seeing business volumes done right down in the run up to Christmas, and so they're really looking to tweak their offering to try and drive in some new applications. Obviously, when you're looking at lending on larger HMOs and multi-units particularly, you're looking at large value properties, therefore the loan amounts tend to be bigger. So incidentally, on their new range they've brought out, maximum loan amount is 2 million, so they're really trying to drive up some large sort of ticket lending in the run up to the end of the year. So look, in terms of Landbay and who they're able to lend to, they're happy to lend to individuals and limited companies. They do not differentiate on pricing, so what we've just talked about applies whether you're borrowing personally or through a limited company. Now, on the subject of limited companies, they can lend to standard SPVs, layered companies, so a company owned by another company owned by people, and they're also able to lend to trading companies as well. So that's where the company has other activities other than simply renting out property. They don't mind how many properties the borrower has in the background, that's not a problem at all, so you can have an unlimited amount there. Some other bits of criteria which are quite interesting, so they will accept applications from anyone at the age of 79 and below. They do want you to earn £25,000 a year worth of income. That can be from rental, but if you've got more than 2 years letting experience, that income threshold drops down to £15,000. In terms of tenant types, they accept all the kind of normal stuff, but more unusually what they do accept is corporate lets. So when you're letting your property out to a business that then fills it with other people. This tends to be, if you think about employers where they have staff that kind of come and visit offices for a period of time and then leave again. That's where we tend to see that arrangement the most. They're also happy to accept lets where the property is rented directly to a housing association as well. In terms of properties themselves, as well as doing the HMOs and multi-units, they accept new build flats, flats over commercial, and also ex-local authority flats as well. And lastly, with Landbay, which I really like, is they are able to do remortgages within the first 6 months of ownership. So a really solid offering from Landbay this week. CHL have also refreshed their offering in the last week, bringing their pricing downwards, again in a kind of bid to drive up some end-of-year business. So their pricing now starts from 2.69%. Now, as a lender, they can go up to 75% loan to value. They don't mind how many properties you have in the background. They do need applicants to be earning a minimum of £20,000 a year income, but this can be from rental. They do day one remortgages against open market value. So when they accept a remortgage in the first 6 months, what they're not doing is saying, well, you paid, £200,000 for it and you've spent £50,000. So irrespective of the open market value, we're going to treat the property as being worth £250,000. What they will do is lend against a full open market value within the first 6 months of ownership. Now they're able to lend on HMOs and multi-units. Currently they're capping their maximum number of rooms and units at 6, and they are able to lend on to individuals, no maximum number of properties in the background incidentally, SPV limited companies and trading companies. Now in terms of CHL as a lender, when I'm reading out this criteria and I'm thinking, gosh, it doesn't sound terribly exciting. Capital Home Loans were a lender who were operating pre-credit crisis, so going way back when now. And then they kind of disappeared for a long period of time, and they've come back to market, and it's been really wonderful to see them return. Now, because they're a newish lender, and this is the same for all new lenders that come to market, they kind of have to enter in a kind of fairly ginger fashion. So they have to kind of, little baby steps in terms of their lending policy. But what we are seeing is, as time is going on, Capital Home Loans are really starting to broaden their lending criteria, which is really good to see. But I think for me, the other thing that I've found really wonderful when we've been dealing with Capital Home Loans is that they are definitely taking a very human approach to underwriting. So rather than just using computer-based decisioning, which some of their counterparts do, what they are doing is really fully underwriting with a real-life person, imagine, the application. And what this has meant is that we've had a couple of cases where the clients have had slightly imperfect credit profiles, so maybe a missed payment on a credit card, that kind of thing, which actually for a lot of lenders would simply rule them out of the game instantly. But Capital Home Loans have been able to really sort of get under the skin of what went on, look at the overall profile of the client and understand that actually missing, one credit card payment 3 months ago does not make them a credit risk. So I think really for us with CHL, what we really like about them at the moment is their very human approach to underwriting. In terms of other lender updates for this last week, so first of all, Barclays have made some very slight reductions on their or some of their buy-to-let rates. As I mentioned, week on week, in terms of Barclays, they are, obviously a very good and well-known lender. Their proposition is incredibly clean, so they're looking to lend to individuals. They're not looking for HMOs, multi-units, anything like that. Now, what they do have is a really interesting approach to the rental calculation. What Barclays do is, rather than having a standard kind of 145% coverage, assuming an interest rate of 5.5% or something along those lines, everything is done on a full affordability basis, which means that if you have a good paid day job and only one buy-to-let in the background, this can often work out incredibly well for our borrowers and accessing the Barclays rates. But anyone who has a large amount of or larger portfolio in the background, it doesn't tend to work for them because they need essentially their affordability calculation to work, and it just doesn't simply come together for these people with larger portfolios. The thing that we find most frustrating about this as a broker is it's just not a very transparent approach actually. So while there is a place for it and it works well for some borrowers, what I would say is that it's not immediately obvious whether it would work for anyone in particular, and often it's quite restrictive. But like I say, the rates have come down. That's great news. Now, we've also seen in the last week Foundation withdraw 4 of their limited edition buy-to-let rates and replace these 4 with just one single rate, which actually is not bad. So the pricing now starts from 3.04%, flat arrangement fee from £1,995. So what they've replaced 4 products with, actually with this single one, is actually not bad at all. Foundation Home Loans, incidentally, will lend to individuals and limited companies as well. No maximum number of properties in the background, no minimum income requirement. They're one of those lenders. Now, Vida Home Loans have brought out a limited edition product also. This is really kind of the fashion at the moment, I think. Really, this is just lenders trying to attract some very quick business in before the end of the year now. So the pricing from Vida, 5-year money now starts from 2.94%. On some of their products, there's no arrangement fee. These are available on HMOs, multi-units, and available for individual borrowing and also limited companies as well. Again, Vida, another one of those lenders, no maximum number of properties in the background, no minimum income, one of those specialist lenders. Zephyr Home Loans have brought out some new green products, which essentially is their existing product range, but with a discount of 10 basis points to 0.1% for any properties which are classed as green. And just to recount, green properties are those with an EPC rating of A to C. This is not available on HMOs and multi-units. I can't understand why that is, if I'm honest with you, but that's kind of where they stand on that point. In terms of the green piece at the moment, we have seen a huge amount of movement towards green mortgages over the last 12 months, which has been really, really great to see. And we're going to see more of that into 2022. As I've mentioned previously, I think the offering The intention is really, really good, but at the moment, if you can access a cheaper non-green product, then you can a green rate. So the green rates are not the most competitive in the market all of the time, then actually it's not going to drive the right behaviours. So as an industry, we've still got quite a long way to go with those. But look, it's great that lenders are having this on their agenda and really starting to make good inroads. Okay, now the Halifax have released their most recent house price index, and I just wanted to share the kind of key highlights with you this week. So what they're saying is that average UK house prices have now reached a new high of £272,992, which is up more than £20,000 compared to the same period last year. So the index revealed that this is the 5th straight month that the average house prices have risen, and is the 2nd consecutive month where house prices have breached £270,000. The average UK house price is up 1% compared to October, equivalent to an increase of £2,808, and on a rolling quarterly basis, house prices are up 3.4%, which the report said is the strongest gain since the end of 2006. Now, the report also added that since the start of the pandemic last year, UK house prices have increased by £33,816, which is the same as £1,691 per month. Now, the Managing Director of Halifax, Russell Galley, has said that the housing market performance was underpinned by the shortage of properties, the strong labour market and strong competition among lenders. So look, in terms of where people are looking when they're considering 2022, there definitely is still an expectation that house prices are going to continue to go up. If you think about what Russell Galley has just said about the things that are driving house prices increasing, none of that is actually going to go away over the next 12 months. Having said that, there is some kind of concern that actually with inflation being so high, some people may be kind of put off buying properties in the very near future, just waiting to see if things calm down a bit. There's some nervousness in the market, but actually on balance, because the labour market is so strong and wage inflation is really, really increasing, actually a large amount of people who kind of report on this sort of stuff are saying that actually it's not going to make any real difference. So look, if you are thinking about buying a property in the coming 12 months, it sounds like now is as good as time as any. Otherwise, you're just going to be paying more money for it if you go back to it in, say, 6 months' time. So that's everything from me this week. We haven't seen any dogs running past, actually, which I have to admit I'm slightly disappointed about. Thank you, as always, for joining us. And we will be back at the same time next week. Like I said earlier on at the start of this, next week will be our last video for 2021. So we're going to do a kind of review of the last 12 months and give you some thoughts about what's going to be happening moving into 2022, including actually what we're hearing that landlords are going to be kind of focusing on and doing. So that should be really, really interesting. But for now, thank you for joining us. If you have any questions, we'd love to hear from you. 0345 345 6788, or have a look at our website. Have a great week, and I'll see you next time.